equity is clearly the topic of the day in the sports industry. I'm going to set the stage for a minute, and then my friend Colin will enlighten us all about the implications of private equity in sport. The topic has become embedded in the mainstream media, whether it's the Wall Street Journal, the Financial Times, all kinds of broadcast television, all focusing on private equity in sport. But it's not really a new thing. Deals have been getting done by private equity firms and sovereign wealth funds in sport, including European sport, for decades. About 4 years ago, some of the US leagues, NBA, NHL, MLS, changed their rules to allow private equity, but most notably, the NFL did it a couple of months ago. Contemporaneously, you saw the PGA take money from SSG. Prior to that, the WTA took money from CBC. So I think that has really shown a light on private equity, and we've seen a variety of funds form specifically for private equity investment in sports. And that, I think, brings us to this moment of what the implications are for our business, both in North America and in Europe. And we're fortunate to have Colin, one of the great experts and deal makers in the space. And Colin, maybe you could just start off by telling our audience, what's the investment thesis of these private equity firms that, as an industry for decades, paid us very little attention in the sports business?
Sure. Before I get into that, I'll just say you left out CVC's investment in Formula One, right, which was a long time ago, which is one of the best private equity investments, certainly, over the last decade. If I zoom out and just take an investor perspective generally, you're looking for three main things when you're trying to deploy capital. One is the target market growing large. Two, is there some sort of moat around the business? And three, are the underlying economics of the industry attractive and growing? And sports checks all those boxes. Specifically in sports, you've got a variety of factors that create a really unique asset class. Historically, as you'll remember, these teams were treated as trophy assets, that a little bit of a cottage industry that grew and valuations grew, but it was very much a capital appreciation play or tax deferral play for billionaires. That has changed substantially in the last 10 years, where the biggest teams and the biggest leagues are global. Our thesis at Raine is that sports is the most powerful content in the world. It is the only thing that you really need to watch live when technology has created so much disintermediation in our culture and society. So you've got a lot of really good underlying fundamentals. And when you look at the track record of these deals over the last 20 years, there's a popular chart that I'm sure people in the audience have seen, that sports outpaces traditional indices for the last 20 years. It's uncorrelated to market movement. So in many ways, it's a very safe investment, assuming the right guardrails are put in place. And I'm sure we'll get into the differences between in the US and Europe.
So let's talk about both the upside and the downside, since both matter to every investment decision. Broadly speaking, sports has value from its media rights and then from the live entertainment business. Media is episodic in the sense that in Europe it's generally 3-year contracts, in the States 6 to 10-year contracts. When you're making an investment day one on behalf of a private equity firm, how do you measure that trajectory, and does that match up with the traditional holding periods of private equity, which were 5-ish years over the period of time?
It's a great question. The hold period in private equity traditionally has, to your point, been shorter than sports investments require, right? Sort of 3-year investment period for a traditional fund, and then you've got another 5, potentially 7 years to monetize. And sports leagues and commissioners who we've talked to certainly don't want to be in a position where owners of teams are forced sellers because they have to deliver capital back to their LPs. At the end of the day, private equity firms work for their LPs. To your point on the media rights, these are typically long-term contracted revenues, which if you're underwriting an investment, tends to be the best, strongest revenue that you can believe in. And you've got counterparties that are some of the biggest media companies in the world. Again, going back to my point, must have content. You feel pretty good that if you're in the US with the NFL, that 98 of the next 100 most watched shows in the US will be NFL games. And the Premier League here, international media rights have, I think for the first time, eclipsed domestic media rights values. which goes to show the other sort of global nature of this asset class, which wasn't really the case, when I started my career.
And when you say international has outstripped domestic, from what perspective? You're just saying the total
value
paid outside the United States?
Well, in the case of the Premier League, the domestic market value had always far exceeded international value, and that has flipped. That dynamic has changed because of so much interest in Premier League's product around the world, in particular in the U.S. In the last decade or so, since NBC first got those rights for, at the time, was a steal. I mean, it was a couple $100 million, and that contract has 3 or 4x'd in 3 cycles.
So there are many factors in any investment decision. Is the principal bet that media rights will outperform global stock market indices?
I think that's one factor. I don't think that's the only factor, because we've seen certain leagues experience some erosion in the value of media rights. So it's certainly something that we always think about when we're either helping a client or making an investment decision ourselves. But I guess the sports IP is so valuable. These are brands. These are cultural assets. These are, in some cases, clubs have over 1 billion followers, which is bigger than many religions, if you think about it. Yeah. And so feeling good that you're going to be able to extract additional revenue streams over the long term is a big bet that people are making now.
And then people also have to consider the downside when they're acting as fiduciaries for investors. I've heard some investors say that one of the attractivenesses of sports is that in various stress moments, whether it was COVID, where we were locked out of our stadiums, the 08-09 recession, the dot-com bust in 01, that sports did not depreciate at the same level as other asset classes. Is that something that you share?
Without a doubt. And some of that is a little bit misled because you're tracking team sales over a long period of time, and there are times when teams don't sell, so you don't have to have a mark. But certainly the asset class is more resilient than most. Actually, the COVID period for our business was extraordinary. I mean, as you said, a lot of the leagues opened up their rules around private capital or institutional capital. And I think, prior to COVID, we probably had 5 or 6 private equity funds that would be interested in some of the assets that we were working with. It's easily 50, and that's just in the US. So I don't see that slowing down anytime soon. There are now sports-specific funds that are being created or have been created, and there's certainly a lot of LP demand for the asset class.
Well, let's talk about the panoply of funds. We have boutique funds, Arctos, Dynasty, Dial, and the like, who obviously are raising money to be sports specific. Then we have the mega funds, Ares, Blackstone, Carlyle, et cetera, CVC. What's the difference in perspective between those kinds of funds when they look at a sport property?
Yeah, so there are some models, and you've named people like Arctos that are investing in what is called common equity, right? So that is essentially you're alongside the owners, very limited rights in what you can do, and it's a bet on growing the growth of the asset class and having diversification, across the asset class. The bigger asset managers like the Ares, Blackstones, I mean, they're sitting on a tremendous amount of dry powder. They have more flexibility in terms of how they can invest, both up and down the capital structure. You're not seeing the bigger asset managers make as many common equity investments. They're tending to look a little bit more like structured equity or credit, and private credit or alternatives in terms of just growth of LP dollars has exploded in the last 5 years, rivaling some of the biggest banks. So that's an area where I think the bigger firms tend to have a little bit of an advantage because they can provide a lot of different types of solutions that some of the more boutiques don't necessarily have, at least today. The flip side is the boutiques tend to be specialists in the sector, and so they can bring additional value to the table when owners are considering bringing on a partner.
Well, let's talk about that for a second, because I think one of the underreported aspects of this phenomenon in sports is when we talk about private equity, people think it's somebody stroking a check for 10% of a club or a league or a media company. But the fastest growing asset class in private capital is private credit, which I think is up to $8 trillion under management right now, growing even more quickly. But talk in a little bit more detail about how firms that have that capability are approaching the sports business, because I think it's something that people don't always recognize.
Yeah, look, when you're thinking about the cost of capital or how much dilution you're taking, if you're in the seat of a team or a league or an adjacent business, common equity tends to be the most expensive, right? You're giving up the most in terms of cost of capital. The big asset managers that are focused on private credit have sort of interest rate expectations that are anywhere between 8 and mid-teens in terms of returns. And so what they can do is design securities that don't necessarily eat into the common equity value of the company, that are downside protected. It's a little bit more of a volume game. It's trying to do as many deals as possible, but knowing that you're going to make a minimum return, potentially with upside. We're seeing that increasingly across our sectors, not just sports, by the way, music, gaming, entertainment. It's a really interesting tool that companies, founders can use to essentially bridge what I think back to one of the deals that we did during COVID with an MLS club where they needed to raise some capital. Obviously, it was a tough environment for valuation, and so the decision was made, let's raise one of these preferred equity instruments that's not dilutive to common, because they believe that the future of their business was going to create a tremendous amount of value. And so they didn't want to give up that value, but they're willing to have a partner that's going to earn a return that's, again, in that sort of 8-9-ish% range, and it works for both parties. So it's a really useful tool. I think that part of the sector will probably be the fastest growing over the next 5 years.
So I think the takeaway, I'm sure no one in this audience works for a club that's losing money, but in the event you were ever to change jobs and go work for a club that's losing money, but where your owner might think that there's more upside, a product like that might bridge the gap between helping you forestall your current losses but preserving some rights to the long-term equity. Let's talk about another difference in perspective, which is if an investor is looking at a property in the US versus a property in Europe, is there a different analytical framework that they go through?
Yes, is the short answer. In many ways, the professional sports ecosystem in the US is much more socialist than Europe. When you're buying a club in the NFL or
very judgmental, by the way. I just want to note
the
that
NBA,
for the record.
We still believe in capitalism, but we also like protections. You're buying essentially the local market economics, which certainly matters, and the biggest markets usually command a significant premium to the smaller markets. But then you're also essentially buying one, either 30th or 32nd of the business of the league. And in the US, the teams themselves don't quite have the same flexibility to monetize their businesses like clubs in Europe, in particular football clubs. One of the things that we talked to people about when we were working on Chelsea or Manchester United was these are global brands that can monetize all over the world. And if you're a team owner in the US, the league handles the international business for the most part. So despite the fact that the Houston Rockets had Yao Ming, generational type talent, personality on his team, the Houston Rockets couldn't monetize their business outside of the NBA in China, as an example. And that same dynamic doesn't exist here. The other obvious difference, to your point about downside, is the concept of relegation, which personally I think is fascinating, but in the US that doesn't really exist today. And that's partially why the valuation discrepancy from the biggest team in a league and the smallest is tighter than you see here, because it really can't get that bad for the 32nd NFL team, because most of the revenue is driven at the league level, and you're not going to be relegated, at least not in the near future.
Well, as a devout capitalist, far be it for me to defend socialism, but I think what I would argue is that the U.S. leagues recognized early on that they were competing with everybody else.
Yeah.
And that therefore their version, their governance has made everybody rich, whereas socialism, as always, has made many people poor. But we'll hold that for another day.
What's the name of this panel again?
Hey, it's campaign season right now. So when we talk about private equity, we talk about private credit, we're really talking about institutional capital, and perhaps the largest and deepest pool of institutional capital is sovereign wealth funds. They've been very active in European football over the years. They're becoming more active in the US. They're becoming active across every conceivable vertical. Where do you see those trend lines going between private equity, which is formidable, but sovereign wealth, which is dominant?
It's a great question. For people in the audience that are not necessarily familiar with this, the sovereign funds tend to be the largest LPs in the most well-known asset managers, private equity firms. So they're already indirectly exposed through their LP stakes in those funds. I think what you're referencing is the direct investment programs, whether that's the PIF or QIA in Saudi or Temasek in Singapore. It's not a one-size-fits-all model for the sovereign funds. At the end of the day, they have to generate returns for their citizens, but various funds have different agendas. Some might want to attract more tourism, so they're going to bring Formula One races. Some might want to just have a bigger presence globally. But certainly in terms of like an impact in type investment, sports is at the top of the list. If you look at what the PIF did with their investment in Newcastle, incredible success in a very short period of time. So I anticipate more of that. We've seen, as you know, Joe, sovereigns finally investing in U.S. leagues and teams. And again, I just know for a fact because we're working on several where I expect more of that to come. And it's the lowest cost of capital typically. So it is the return profile for a sovereign fund is single digits, sometimes low single digits. You're basically trying to beat GDP versus the private credit or the private equity funds that are 20+%.
So return profiles is always an important issue when you're talking about something like private equity investment or sovereign wealth investment. One of the things people debate is, are private equity firms going to generate the same rate of return, whether that's over 3 to 5 years or 10 to 12 years in a sport investment as they would in another investment? And how do you think they're thinking about that? And are they actually lowering their return profiles for other strategic reasons?
I think they are lowering their return profiles, and to your earlier question, they're raising dedicated pools of capital that the expectation of the LPs is a lower return. Now, in exchange for that, you're typically getting a safer investment, one that may pay current dividends, in the case of some of the US leagues at least. But certainly the asset class, because it is so competitive, because these are trophy assets that command premium valuations, it is a little bit harder to underwrite to 30+% IRRs. And that's okay, because they have a lot of other opportunities where they can get that exposure or alpha in other industries. But I certainly think when people are making these investments, they're not saying, we're not going to make a great return. I think everyone's going into an investment thinking it's going to be a great deal. The question is, if you're a traditional private equity firm versus one of the more structured type firms, and you'll hear from Russell next, and I'm sure you can talk about this a lot. It's just, what's your expectation going in, and how do you design the capital or the security to meet that expectation? So yeah, the return profile is definitely lower because prices are higher when you're coming in.
And people in this audience that may be representing a property or a team or a league that's a seller right now, when you say that sovereigns have a lower rate of return, does that just mean they'll pay more, and that if you're looking to drive the highest price, leaving other factors out of it, that's likely to be your best bidder?
If you read the economics textbook, that's what it would say. If you have a lower cost of capital, you can afford to pay a higher price. Again, it's not a one-size-fits-all. I think there are different investments where sovereign funds may have other reasons for doing that investment, which could justify a premium. And then there are others where they don't see that justification. And we're seeing that in the market where some of the sovereign funds are becoming more disciplined in how they evaluate the sector.
And one of the factors that goes into any investment, particularly a sport investment, is the closed shop. There's only so many clubs in every league. When you're thinking about US versus Europe, particularly in football investments, if you buy the NFL or the NBA, you're basically getting the only dominant league globally in that sport. When you're talking about an EPL club, a La Liga club, a Serie A club, an MLS club, right? They're all competing with each other on a global basis. How is that analysis different than the NBA, NFL kind of single source investment profile?
Yeah, football is the largest sport in the world by far. So despite the fact that it is more fragmented, it is the biggest market opportunity. When we talk about other leagues, the NBA is one where it is a global sport. The NFL, amazing product, obviously, tremendously successful, but it's early innings of being a global sport. The NBA, as an example, sort of defines basketball, is basketball. And so the opportunity there globally exists that doesn't really exist for the other sports that you mentioned. But again, this is a world of globalization, so the Premier League is huge in the United States. And if you had asked me that 15 years ago, I wouldn't have really believed it. So it's definitely a different calculus. I think there's always, you're going to rank the quality of the leagues when you're talking about football in particular. Certain markets have better media trends, as an example, or better opportunity. And there will always be a hierarchy, but football is global, so people are going to continue to invest and make bets.
Let's talk about some of the ancillary businesses. You were obviously a very early and successful investor in DraftKings. If we were doing this 3 to 5 years ago, everybody would have been talking about the trajectory of gambling. Are there other ancillary businesses that you think the private investment community is going to be attracted to, whether that's stadium and arena development, ancillary real estate around the properties, other sorts of technology? What are you seeing people looking at?
For our fund, we're a growth equity investor, so we're partnering with founders and management teams. We're not as big as the big asset managers, so we're writing smaller checks, which means we're typically investing in earlier stage businesses. Our thesis at our firm is that while we haven't invested in teams per se, because we do so much work with teams, generally speaking, in our advisory business, these are really good businesses that you can piggyback on. And so the thesis with DraftKings when we invested was, you've got an evergreen content engine, which is live sport. You've got essentially the first social network ever, which was fantasy sports. And you've got technology that's putting computers in everyone's pockets. And this whole concept of a second screen experience, and younger generations not wanting to sit in front of a game for 3 hours or 2 hours or 4 hours, and having other ways to engage is an area that we spent a lot of time thinking about. We will definitely see a lot of investment in and around sports, to your point. Software businesses that are being developed specifically to address issues with the sector. I would say we haven't talked about women's sports, but women's sports is exploding.
And why do you think that is? I mean, people are saying women's sports was having a moment. That's more than a moment, right?
Definitely
it's been a long-term trajectory, but WNBA values and the National Women's Soccer League values, other women's sports values are increasing. What do you attribute that to?
I attribute it to growing interest, which is fantastic, driven by a handful of incredible athletes and women that have captured the zeitgeist. Certainly helps. I also view it as we talked about so much capital is entering the sector, and if you're trying to find an investment opportunity where you can underwrite to those bigger returns that we referenced, the entry point matters. And on a relative basis, a lot of these teams and leagues are just underpriced. And so as an investor, you see that opportunity to seriously grow value. The underlying trends of women's sports and men's sports, I don't really view as different. It's still sport, it's growing, media is catching on finally, and big brands are entering the space. It's long overdue.
Well, we're getting lots of great questions from the audience, so thank you for that. Here's one that is of particular interest to me is, what are your thoughts about private equity investments in youth sports?
In youth sports. We started this as it's capitalistic business. People will look for return. The youth sports business, again, in the US at least, I can give that perspective, is incredibly fragmented. You've had sort of mom and pop operators that have created what's called these clubs where kids are now playing one sport all year round. When I grew up, I played as many sports as possible, but they were confined to a season. That model has been turned upside down in the US, and you have parents running around. I have three kids, and I anticipate the day soon where I'm going to be going to random cities around the United States for various sports tournaments. I don't think that element is necessarily so healthy for families and for kids, but I do think there is an advantage to having scale around these businesses and combining a lot of the mom and pops and best practices and creating sort of synergy at the cost structure level. So from an investment opportunity, it's largely untapped, and so I think you'll see a lot of consolidation in that sector over the next 3 to 5 years.
So when money flows to a property the property starts to focus on its content? Are we going to start seeing 12-year-olds getting paid lots of money to move from one league to another, from the KKR League to the Blackstone League? Or
it was hard for me to imagine like freshmen in high school signing college deals, and that's
been happening for years.
I know, but I'm saying 10 years ago that was that was happening, and that's sort of mind-boggling to me. I don't think it'll go that young. I was with someone from City Football Group last night, and they just signed a player, I believe he's 14 years old, who plays for the Philadelphia team in the MLS. So I think looking for the next superstar won't go away. And NIL has certainly changed the game in college. I mean, you have backup quarterbacks for some of these universities making multi-million dollars.
Right.
When I was 18, having a multi-million-dollar contract would have been pretty cool. But
yeah.
I don't think it's so great for the ecosystem, to be fair.
Another audience question. They want to know whether Colin thinks Jim Ratcliffe was the winner or the Glazer family was the winner in their deal last year. Well, it's heads or tails.
They're both winners, and here's why.
Because we're talking about youth sports, everybody's a winner, right?
Well, we started with socialism, and now we're getting into diplomacy. I would say, look, the Jim wanted to run the football operations, and he's doing that. I think the Glazers acknowledge that he brought a lot to the table. Obviously, an incredible valuation for the club, primary capital for growth. So it solved a lot of challenges that we were facing when we started that process.
Another question from the audience was, we talked about sovereigns being a big backer of private equity firms, but whether you're seeing new kinds of investors coming into sport, either by type of investor or otherwise.
I mean, when you and I were selling teams 15 years ago, it was the rich guy or woman, right, that wanted to buy the team. Now it's a combination of strategics, which I never thought would really be the case, but you've got corporates, especially in America, that were involved in many of our football processes that they'll remain nameless, but would surprise, because they're public companies, but they would surprise a lot of people. You now have the sovereigns, as you said. You've got these holdcos that are forming, where you've got multiple assets. Fenway is one, HBSC is another, Monumental Sports, where they raise money from QIA. Their plan is to build, sports empires, and so that's a different type of investor. You still have the high net worths, you always will.
Let's focus on those platform investors, because does that make it easier for a Monumental or HBSC, Fenway, to bolt on perhaps a smaller property that a big major PE firm would just say is too small for them?
Definitely. And also, part of the thesis, I assume, is that there's all these shared services, shared learnings across teams, or whether they have services businesses or software businesses that you can apply and create more value. You don't need the same level of sales, as an example. If you have multiple teams, you can leverage some of those assets across multiple properties. So which it's a great investment thesis. And as we started this panel, they've tended to outperform everything. So if there's someone that owns one of those holdcos that, again, will remain nameless, but he said to me once, if I could go back 15 years ago, I would buy every single sports franchise that came across my desk.
So that brings us to the ultimate question when you're talking about private equity, which is how do you get out to realize these returns? We all see the asset values on paper. So we're still in the honeymoon phase of investment. It's only been a few years, but 5-10 years from now, everybody's going to be looking to get out of these. Who are the buyers?
Yeah, we talked about LPs being the ultimate bosses of these private equity funds, and they do want their money back at some point, even though the period is longer in this sector. I don't think there's a great answer for some of the, like the NFL as an example, yet. There will be trading amongst firms. There will be securities designed that we're seeing where there is no sort of terminal value. So you get back to the flexibility point of those asset managers. They can underwrite to a specific return and have it just burn off. So you don't actually have to come up with capital to buy them out. I see that trend increasing. The public markets will be available for certain businesses in and around sports. TBD if that's a good thing, because if you look at the valuations of public sports companies, they typically are not nearly as high as the private valuations. But I think that's the big question. And DPI matters in private equity, which is dividends paid in, returning capital. The obvious other way to get out is the owner decides he wants to sell, and you have a tag right, or you can participate in that deal. But I think that's, on the team side specifically, that's a little bit of the unknown. But again, these funds have raised capital with the expectation that they don't necessarily control their exit, which is almost the antithesis of traditional private equity, where you basically say, I'm buying this widget company, and in 5 years, we are going to sell it. We're going to hire Joe, hopefully, and Colin, and we're going to go and sell that business. You can't do that in sports.
So if we're doing this in 2034 and we're looking backwards, are the private equity managers going to say, we were just as smart as that guy that said in 2010, I'm going to buy every sports property I can, or there'll be a little bit of buyer's remorse?
I don't think you'll have, there will always be buyer's remorse when you look at specific assets, but broadly speaking, I don't think they will look back and say, we wish we didn't do that. I'm not sure the value creation sort of multiples that we've seen in the last 20 years. When you're buying a team for $200 million and it's now worth $8 billion, there's obviously substantial growth on the come, but those multiples of your money are going to be harder to find.
Well, Colin, thank you for a great 30 minutes. Thank you to the audience for great questions. Really enjoyed them. Sorry we couldn't get to all of them.
Thank you.
Season.